The moment you see Bitcoin halving on your screen, the first thing that probably pops into your head is, all right, here we go again, another event that's supposed to send the price to the moon. But what is halving? Why does it happen? And what does it actually do for me in 2026? That's exactly what we're going to break down in this video, clearly and without the hype, because halving is one of the most talked about and most misunderstood mechanisms in Bitcoin. People sometimes treat halving like a promotion, like someone flips a switch and the price goes up, but halving is a rule baked into Bitcoin itself. There's no CEO, no boardroom, no team saying, let's run a discount this year. The rule runs, and it doesn't ask anyone for permission. So let's start with a basic question. Where does Bitcoin actually come from? How is new Bitcoin created? Think of Bitcoin transactions like entries in a ledger. That ledger is the blockchain. It moves forward page by page. Each page is a block. Roughly every 10 minutes, a new block gets added. And when that block gets added, the miners who secure the network earn a reward. That reward has two parts. First, the Bitcoin the system mints for that block. You'll hear this called the block reward or the subsidy. Second, the transaction fees paid by the transactions included in that block. Halving is the event that cuts that first part, the newly minted Bitcoin, in half. Okay, but why does it cut it in half? Who decided that? Nobody decides. Bitcoin's monetary policy was written from the start. It's basically automatic belt tightening, not random, planned, because Bitcoin's whole promise is the total supply is known. No surprises, no, let's print a bit more today. The maximum number of Bitcoin that can ever exist is capped at 21 million. As Bitcoin approaches that cap, the rate of new issuance slows down. Halving is the most visible piece of that slowdown. Let's make this more concrete. In the early days, miners earned 50 BTC per block. Then it became 25, then 12.5, then 6.25, and in 2024, it dropped to 3.125 BTC. So in 2026, we're still at that level. Until the next halving, the network keeps issuing 3.125 BTC per block. Now pause for a second. 3.125 BTC per block can sound abstract. Let's translate it into everyday terms. On average, about 144 blocks are mined per day based on the 10-minute target. Before 2024, that meant around 900 BTC per day in new issuance. After the halving, that dropped to about 450 BTC per day. The daily flow of new supply into the market got cut in half. That's a real mechanical change on the supply side. But here's the immediate question. If supply gets cut in half, does price automatically go up? If only economics were that simple. Supply alone isn't enough. You need demand too. And the market knows halving years in advance. The schedule is public. It's not a surprise. That's why the price pumps on halving day expectation usually leads to disappointment. Sometimes it's priced in early. Sometimes it shows up later. Sometimes something totally different happens. Halving can be a spark, but it's not the whole engine. Still, what makes halving important isn't the story, it's the math. Halving reduces Bitcoin's issuance rate, and inflation here doesn't mean the price of groceries. It means how fast the money supply grows. Halving slams that growth rate downward. In a 2026 context, that means Bitcoin's supply is still growing, but it's growing more slowly than before. And that's the core mechanism behind the long-term scarcity narrative. Now we get to the real point. Halving isn't just something investors talk about. It changes miners' lives immediately, because a miner's revenue gets cut overnight. Who are miners and why do they matter? Miners are the ones securing the Bitcoin network. They validate transactions, produce blocks, and make attacks expensive. In return, they earn revenue. Now think about it. If a miner's revenue drops, what happens? Some miners can't survive and shut down, especially the ones with high costs. If electricity is expensive, hardware is outdated, or efficiency is low, that operation gets squeezed. And this is where another Bitcoin mechanism kicks in: difficulty adjustment. The network targets a new block about every 10 minutes. If miners shut down, total hash power drops and blocks slow down. The network notices and adjusts difficulty roughly every 2 weeks. If difficulty drops, the remaining miners can find blocks more easily, so the system tries to rebalance itself. That self-balancing is great, but it comes with a cost. After halvings, miners are often under pressure. Revenue drops, costs don't. So miners start watching two things like hawks: Bitcoin's price and transaction fees. If price rises, revenue rises. If fees rise, revenue rises. If neither rises, miners get squeezed. And here's a critical question, especially looking ahead from 2026. In the future, can miners survive on transaction fees alone? Because the subsidy gets cut in half every halving, it trends towards zero over time. Eventually, new Bitcoin issuance becomes extremely small. So what funds security then? The answer is transaction fees. But will fees be enough? That's still an open, very real question, which is why talking about halving in 2026 as just will price go up is shallow. The bigger issue is how Bitcoin's fee market develops. Some periods the network gets congested, fees rise. Some periods it's quiet, fees fall. Fees are driven by on-chain demand, and also by second-layer solutions like Lightning. If people move activity off-chain, on-chain demand can drop, pushing fees down. But if on-chain demand piles up, fees rise and can support miners' revenue. Here's the funny part. Some solutions designed to make Bitcoin cheaper and faster could, if they reduce miners' revenue long-term, expand the security debate. That's technology for you. Fix one thing, something else starts making noise. Now let's clear up another common misunderstanding. Halving makes Bitcoin harder to find going forward, but it does not reduce the Bitcoin that already exists. No one's coins disappear on halving day. Only the rate of new issuance changes. It's not like an oil field shutting down. It's like new oil coming out more slowly. So why is halving so tightly linked to price? Because price is often driven by marginal supply and marginal demand, the newest buyers and the newest sellers. Miners are one group that tends to show up as steady sellers because they have electricity bills and operating costs. After halving, the amount miners may need to sell can decrease, so sell pressure can drop. Because sometimes the opposite happens. Revenue drops and they need more cash to cover the same costs. This is also why the phrase halving always leads to a bull market is half true at best. Historically, we've seen big moves after halvings, yes, but it's not a guaranteed rule. Every cycle has different macro conditions: interest rates, liquidity, regulation, exchange behavior, institutional interest. One cycle has high risk appetite, another cycle is dominated by fear. So for 2026, halving is already in the rearview mirror and we're in the digestion phase, which raises the next question. Is the halving effect over or is it still working? The healthiest way to look at it is this: halving isn't a day, it's a period. The effect isn't instant, it's cumulative. Since 2024, every single day the flow of new supply has been lower. Over months, that difference adds up. 1 year later, 2 years later, total new issuance is meaningfully smaller than it otherwise would have been. If demand stays the same, the balance can shift. If demand rises, the impact grows. If demand falls, the impact fades. But the supply rule doesn't change. Let's do a simple thought experiment. Say global net demand for Bitcoin increases by 500 Bitcoin per day. That demand could be exchange buying, companies accumulating, individuals, funds, all of it combined. If daily new issuance is 900 BTC, supply can absorb that more easily. But if daily new issuance is 450 BTC, the same demand starts pulling harder on existing supply, the Bitcoin already in circulation. That can affect price. But again, is demand stable, rising, falling? That's the market. So does halving make Bitcoin like gold? As a comparison, yes, because gold's supply growth is limited. But Bitcoin has one key difference. Gold's supply can respond to price. If price rises, more mines open and production can increase. Bitcoin doesn't work that way. Even if price rises, the block subsidy stays the same. Difficulty adjusts, miners redistribute revenue, but you can't change the issuance schedule. That makes Bitcoin's supply side more rigid than traditional commodities. Which brings us to this. Halving is basically Bitcoin's central bank policy. Just a robotic central bank. One job, follow the rule. Now ask yourself, if Bitcoin's supply is so clear, why is everyone still confused? Because supply is clear. Demand and human psychology are not. Markets aren't driven only by math, they're driven by emotion too. Fear, greed, herd behavior. Halving is the perfect stage for those emotions. People hear the word reduction and their brain instantly triggers a scarcity alarm. Sometimes that alarm is right, sometimes it goes off at the wrong time. In a year like 2026, the real question becomes, are people copy-pasting expectations from past cycles, or are they looking at the data? Quick reality check. There are a few cliches that circulate every halving. Let's clean them up fast. Halving cuts supply in half, so price will definitely go up. No, it cuts new issuance flow in half. Price depends on demand. Halving is a surprise. No, the schedule and rule are known. The surprise is how people react. Bull market starts immediately after halving. Sometimes yes, sometimes no. Timing varies. Halving lowers transaction fees. No, fees are driven by on-chain demand. Halving ends mining. No, it pushes out inefficient miners and can strengthen efficient ones. Difficulty adjustment is real. Let me paint mining more realistically. A miner isn't some romantic hacker in a hoodie. It's warehouses, machines, fan noise, power contracts, maintenance teams, financial planning. The formula is simple: cheap electricity, efficient hardware, strong operations. When halving hits, the efficiency bar rises. Someone who survived yesterday might fail today. So if miners fail, does the network collapse? No, the network doesn't collapse. When miners shut down, hash power drops, blocks slow for a bit, difficulty adjusts, and the system moves back toward the 10-minute target. But here's the thing: when hash power drops, the market talks about security perception. That's why halving as an ecosystem stress test is a more accurate framing. After halvings, miners often face pressure because revenue drops and costs don't. They watch price and fees. If neither helps, they get squeezed. Sometimes you'll hear the word capitulation, meaning the ones that can't survive eventually tap out. Now let's make issuance even more concrete. Post-halving, we said 3.125 BTC per block. About 144 blocks per day means around 450 BTC per day. Over a year, that's roughly 164,000 BTC. As total supply grows, that percentage shrinks. That's halving's real power, reducing the growth rate. Why does this rate matter? Because the faster an asset supply grows, the higher the dilution risk for holders. Bitcoin positions itself as the opposite, a system where supply growth slows over time. Halving is when that promise visibly executes. And that famous question, if everyone knows halving is coming, why isn't it fully priced in? It often is priced in, just not at a single moment. People react differently to the same information. One side says already priced, another watches macro, another focuses on technicals, and net inflows, real demand, change day by day. So even a known event like halving can only express itself over time, alongside actual demand. One last misconception: halving doesn't make Bitcoin's total supply 21 million. It already is designed that way. Halving just controls the pace at which we approach that number, and the pace gets so slow that it turns into a rule that plays out over decades. As we wrap up, here's the key: if you treat halving like a mechanism, not a myth, Bitcoin becomes less mystical and a lot more understandable. Halving doesn't mean Bitcoin got reduced. It means the rate of new Bitcoin production got reduced. The difference sounds small, the impact is big. And yes, the question everyone still has is, should I buy Bitcoin in 2026? I'm not going to tell anyone to buy or sell, but this is clear: talking about Bitcoin without understanding halving is like talking about a car without understanding its gas tank. The car moves, but when it runs out, when it performs, when it's risky, you won't understand that without knowing the tank. From now on, whenever you hear halving in Bitcoin content, ask this: how much is new issuance dropping? How might miner sell pressure change? How much are fees contributing to miner revenue? Is there real net demand coming in? If you ask those questions, you're one step away from the noise. And in markets, stepping away from noise is often the most profitable move, because noise is free and mistakes are expensive. Today we moved halving out of the will price go up zone and into what it really is: Bitcoin's math and the mining economy. If you want one sentence to remember, halving doesn't make Bitcoin scarce overnight. It slowly shifts the balance by producing less new Bitcoin every day. From here, keep an eye on three things: the issuance pace, miner resilience, and how much transaction fees fund the network. Because in the long run, those are what write the story, not tweets. Thanks for watching. In the next video, we'll talk about why post-halving periods can produce unusually sharp moves and the liquidity mechanics behind that.